Hey everyone, welcome back to another episode of AWM Insights. It's your Power 3, 2 CPWAs, and a CFA. We are Erik, Brandon, and Justin, and we are closing in on the end of 2020 here. It is Christmas week, and what a continued wild ride that we're seeing in 2020. It's hard to believe that we're 40-something weeks from when COVID started. We've seen the financial markets drop downwards of 30%. We're now up positive around 17, 20%. But really what we want to talk about today is the asset class that's up over 200% and whether as an investor you should have cryptocurrency in your portfolio. And so I don't want to overhype this. I just want to jump straight into the conversation. What are the opinions around cryptocurrency that you guys got?
Wow. What dynamite drop in. We're glad to have you back, Erik.
That
introduction.
I missed you. I was last week, I was mining for some Bitcoin down in the dungeon of the basement. And unfortunately, I figured out that it is not under the earth. So wasted. And I had to come back, and work for you guys.
Amazing. I think crypto, what an amazing topic. I think there's so much information that's out there right now. And trying to figure out where you fit it in your portfolio is always a great conversation to have with clients. And I think, from my standpoint, I'm probably the most opinionated of the three of us on this. I just have such a hard time trying to figure out what the value is. We talked about gold a few weeks ago. When I look at Bitcoin, I think there's lots of uses. I think the blockchain technology it's built on is fascinating. But we're really looking at this, or the only way I can look at it is this a currency replacement for maybe the US dollar, the euro, the yuan, whatever it might be. And I struggle with how to value this stuff. But Justin, I mean, we've talked at depth about how to value it, what the purpose is. I'd love to hear your take on it.
Yeah, well, first and foremost, I mean, these conversations are part of what I absolutely love about our job, right? We get to kind of, dig into something new, something interesting, debate it, and reach a conclusion, hopefully, but really take our time to learn about something new, something interesting. So first, let me say that I love the job overall, but that in Bitcoin specifically is fascinating example of what we get to do on a daily basis. But yeah, I think Brandon, you hit the nail on the head. Like, when it comes to investing, you need to be able to value something. Valuing an asset generally takes cash flows. Bitcoin doesn't have that. It really, at this stage in the game, is speculative, right? It's valued based on an assumption that it will be adopted as some mode of exchange or currency, kind of to your point, Brandon, down the road. And that there's no guarantee. Will it happen? Totally possible. More and more institutions are now allowing some kind of access to it or acceptance of it for exchanging products or services. So that's potentially an indication, but it really is a speculative asset. And Erik, I think you highlighted the rate of return for the year to date. I just want to highlight that there are other assets within the global financial asset marketplace that have done better. Bitcoin just happens to be one that's capturing it. The hearts and minds, if you will, of the news media and some investors. So,
and I think the reason it's capturing it, just to put it in a reference for our listeners, is we've seen $11.5 billion worth of cryptocurrency, Bitcoin specifically, be purchased in the last 90 days by institutional investors. And so it's really caught the eye of Wall Street. Bitcoin and cryptocurrency is nothing new. This really started in 2008. And for our listeners that maybe even this is new to them, is cryptocurrency is it's typically a decentralized digital money designed to be used over the internet. And so Bitcoin is not the only one. There's Ethereum, there's Litecoin. There are, as Brandon will point out, over 3,000 types of cryptocurrencies. So while this isn't a new conversation, it's really something that a few years ago Wall Street didn't want to touch. and now you're seeing institutional money dropping into this market. And so just love to hear your thoughts, Justin, of why we're seeing big institutional money entering cryptocurrency.
Yeah, well, I think it goes back to something I touched on, right? The money that is going into cryptocurrency right now is more speculative in nature, right? It's institutions that are carving out a portion of their asset allocation and speculating on this new and interesting asset class. It makes some sense. So I think that's driving a lot of the institutional side of things. Kind of on the flip side of that, you have to ask yourself, are these institutions actually just buying the coin itself or the cryptocurrency itself, or are they trying to be like the Coinbases of the world and provide the picks and axes back in the day? What folks did, the people who really got wealthy off the gold rush, right? They supplied the resources or the platforms for people that were interested in finding gold and mining gold. And a lot of institutions today kind of fall more into that camp. They're not necessarily buying the asset class, although there are some cases where they are doing that. But a big company you hear about is Grayscale. Grayscale is actually providing a platform for access to the asset class, and they're profiting off of that aspect of it. That's exactly what Coinbase does, and Coinbase is jumping on the IPO bandwagon this year. They just filed to go public today, actually, when we're recording this on the 17th. And
we're gonna. That's just, and I don't want to lose sight of the IPO thing. It's fascinating. 22 IPOs this year. On the day that they've opened have doubled. I mean, just wild returns. We're going to do a future podcast on that, but I feel like it belongs in that speculative conversation of trying to catch the IPO, right? Or, now this is on an upswing of 2,000 or 200% returns. Like, the speculative nature, if somebody's going to use money to invest in the speculation, like, how should they think about this? Is this just like an absolute no? Nobody should put any money in these categories. What are your guys' thoughts?
I mean, I don't think it's a hard no. I think it's a situation where if you really understand what you're getting into, you understand the risk that you're willing to take here, then certainly it could open you up. I think we've talked a lot about how, we plan for our clients. If you've got that protective reserve set aside, you've got the wealth that's going to, provide for your family and your priorities for the rest of your life. And you want to take a shot here. I don't think there's anything wrong with that. I think you should still only take a very minor piece of the puzzle and speculate in this case. I mean, I think the other thing people lose sight of in good times, right? 200% returns, that's enticing. It's, I want to participate in that, but then you start to look around, and I think most people would probably find it interesting that the Bitcoin's actually corrected greater than 30%, so declined greater than 30%. Since 2012, it's done so 13 times. There was a 3-day period that it actually dropped 87% in 3 days. I don't care who
Ouch.
you are. That's a tough period of time to go through. So I think when you're looking at adding something like this to your portfolio, I think oftentimes we get enticed by the big upside, right? It's sort of the gambler's fallacy. It's, hey, I could go in, and if I hit, I hit the number on roulette, right? It's going to pay me whatever it is, 37 times. If I hit the 14 parlay, think about what that's going to pay off. Well, there's a reason why the payoff's so big, because the downside is also so great. So I think when you're looking at this, it's far from a sure thing. I think where it makes it difficult for us to ascertain, like, is this an investment, is how do you value it? How do you set what your upward parameters are and what the risk on the downside is, and come up with the risk reward spectrum? I think that's tough. I think if you're looking at it though, and you do have a little bit of the fear mentality.
FOMO.
You got the FOMO, or you got the fear mentality. You're concerned that the US dollar is going to go away and this is going to replace things, or you're one of these people that think you're going to leave the US for whatever reason and you need to get your money out. I mean, all those things, I think, sure, could be a rationale around it. I think that's pretty doomsday personally. But, I think the other things, when you look at a currency like this, some of the I think it's funny, some of the benefits they talk about, it's a constrained amount. Justin and I were talking about this morning. There's 21 million Bitcoin. So people turn to that and say, hey, there's a finite amount and it's going to, go into the value. Well, did you know that you could actually divide Bitcoin up to 8 decimal points? So I didn't do the math to figure out how much Bitcoin's actually out there, but it's far more than most people realize. So I think, there's a lack of understanding essentially. Well, and so.
And it must be the holidays, because I want to point back is that this was a fun thing that I did 2 years ago, November. We were having these same conversations when Bitcoin was hitting 18,000. I mean, our clients, I literally did this and I'm glad, like, he laughed about it. I scrolled up in a text message conversation from 2 years ago with a client of ours and said, hey, do you remember what we talked about? Here's that same podcast that we talked about. Here's the same resources. This is our stance hasn't changed, and it's been a wild ride. They were really glad they didn't get back in November of 18, because Bitcoin went down to 8,000, and sure, it's up over 22,000 right now. But one of the things I'd love to hear from you, Justin, is we hear an argument from asset allocation that it's uncorrelated. Should we just try and find really uncorrelated things and put our money in it because that supposedly lowers our risk in our asset allocation?
No, great question. I mean, the math around what you're saying is true, but the uncorrelated asset needs to be really clearly understood, right? Just because something is uncorrelated doesn't mean it automatically gives you added returns. Kind of to Brandon's point, you can't really value it. This particular asset class we're talking about with cryptocurrency is incredibly volatile. We don't really know what the true uncorrelated nature of the asset class is yet. So it's really, really hard to answer that question accurately, right? You can make some sort of assumption and say, oh, well, yeah, it is. It's totally uncorrelated to US stocks, as an example. Well, I mean, from a historical perspective, maybe you can make that argument, or it's uncorrelated to gold, or whatever the case may be. But you're talking about a really, really short sample size, a really short period to draw that conclusion on. And given that it is such a new asset class and could potentially be regulated in some way, shape, or form, or could be adopted, or the Fed could come up with their own cryptocurrency and wipe it out, right? Like, you cannot make an allocation decision based on the past history. It's just way too short. We don't know what the characteristics of the asset class are from an allocation perspective. And I want to just touch on something too that Brandon said. Like, I don't think this is a hard no. If you understand the risks, the volatility, you're comfortable with that, you understand the security measures you have to take with keys and wallets and all that stuff, the prudent thing to do is to right size your allocation, which is probably a pretty small percentage of your asset class, right? You're not going to put anything substantial, north of a couple percent in an asset class like this that is more speculative in nature, and people really lose sight of that. They think, oh, Bitcoin has earned 200% or returned 200% this year. That's fantastic. If I would have been invested in it, my life would have changed. No, if you did the prudent thing, it would have helped your rate of return a little bit, but it wouldn't have changed your life. What truly matters within our framework for constructing portfolios is looking at your overall financial structure. So that includes financial assets. So those are the things that are invested in the market, your cash, your stocks, your bonds, but then your human capital. And most of the time, your human capital is the most powerful asset you have from a rate of return standpoint, right? Making sure you harvest the potential for your human capital and then bring that into an investment portfolio that is prudently managed, right? It's reframing the thought around investing where, Bitcoin is not going to really change your life. Your human capital and executing on that is really what's going to change your life, if you will.
I think another quick note from the uncorrelated piece, that certainly didn't show up earlier in the year. When financial markets were correcting. I just looked it up. I mean, from March 1st, and these are arbitrary dates, but March 1st to March 16th. So a 15-day period, the price of Bitcoin went from $8,500 to a little under 5,000. So when there was stress in the world, it wasn't Bitcoin to the rescue. And I think if you turn to some of the the best thinkers on this subject, Naval Ravikant, or, I think it's Chris Sabo or Nick Sabo, mispronounce his name probably, but, I think those are great places to turn because they're not necessarily looking at it from an investment standpoint, right? They're looking at it for some other belief system. They believe that the currency effect is going to take into account. So, I think just to reiterate, it's not a hard no. You just need to know why you're buying it. And you shouldn't be buying it for the speculative move of an investment return necessarily, especially as any meaningful part of your portfolio, as Justin said.
Yeah, I think that was super helpful. And leaving it with you as the audience, right? You've worked extremely hard for the money that is in your pocket. And we want to make sure that you have a plan in place that first is maximizing that after tax and then giving you the best chance to succeed at achieving your priorities and the outcomes that you want. We've talked on previous episodes about the danger of just chasing return. We, as you know here, have a strong allocation to venture capital when it makes sense, but we always caution with the amount of risk and illiquidity and those type of things. So you deserve a personalized, a customized investment plan that is really tailored towards hitting your outcomes. And so, it's one of those things that if you are getting excited about cryptocurrency, if you're comfortable taking that amount of money to Vegas with you, we'd say, hey, have fun. It's something that can keep you excited about learning about the markets. But ultimately, this is about being a pro with your money. And so until next time, stay humble, stay hungry, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.